Hi, I'm John Mark Young, President and Chief Investment Officer of Whitaker-Myers Wealth Managers, and I'd like to welcome you to another installment of the Whitaker-Myers Wealth Managers What We Learned in the Markets This Week video. Remember, our aim is to provide you, our valued clients, with a brief video giving you information that is helpful to your understanding of the markets from a biblical worldview with no financial agenda, which of course makes us uniquely different from the news media in America. Remember, this video is for informational purposes only and should not be relied upon to make investment decisions. The clients of Whitaker-Myers Wealth Managers may maintain positions in the securities discussed in today's videos. And of course, all opinions discussed are solely those of John Mark Young and not those of Whitaker-Myers Wealth Managers. So let's talk about the 4 things we learned in the markets this week with point number 1. And point number 1 was, do you remember last year when the markets kept taking good news and making it bad news? We'd have a blowout jobs number and the market would drop 1% because of the theory that the Federal Reserve would be forced to continue inflicting pain upon the economy through higher and higher interest rates. Well, that theory was laid to rest, at least in the interim, because last week we continued to receive good economic news, and that news has continued to prove the theory from a few of us realists, people like Ryan Dietrich, who's the chief market strategist of the Carson Group, or Brian Belsky, who's the chief investment strategist of BMO Capital Group. And of course, I've been saying that on these videos, that there is no recession, at least in the immediate horizon, when you see data like we're seeing. I'll get into the jobs number in point number 2, but before we do, let's discuss 2 stocks that caught our radar this week. The first is, because my daughter's always begging me to buy clothes from there, and it seems like she's not the only one. So athletic gear maker Lululemon Athletica, they surged 11.3% this week after the company let investors know they expected China sales to expand their sales numbers. And Amazon. Do you remember when Amazon bought Whole Foods? They got into the grocery business. Well, at that time, grocery stocks got completely wiped out because if there's one company you don't want to have to compete with, it's Amazon. Well, this week, rumors were leaked that Amazon is considering offering a mobile phone service for its Prime members. Now, it seems they'll buy the mobile coverage they need from Dish Network, who also saw their shares rise this week because of that. And that functionally killed the return from stocks like AT&T, Verizon, and T-Mobile, just as it did those grocery stocks years and years ago. It's hard to compete with brand loyalty that Amazon has created. Now, also each week, we look at the weekly claims for unemployment insurance as one of our recession indicators. This week, they came in at 232,000 initial claims for unemployment insurance, which is slightly higher than last week, but still in line with the low numbers we have seen this entire year in 2023. And finally, are you ready to see what the markets did on this holiday-shortened week? Well, the S&P 500, which is our proxy for growth and growth in income stocks, but only when considered together, not separately, that was positive 1.83% for the week. The Russell 2000, which tracks our more aggressive growth, smaller companies in our Dave Ramsey vernacular, that was positive 3.33% for the week, which is not surprising considering how much it's lagged everything else for the year. The worst becomes the best becomes the worst. And to that very point, and finally, the MSCI EFA, which has been the best most of this year, and that tracks international stocks. That was only positive 0.71% for the week, so it was the laggard after being the leader most of the year this year. Point number 2. As discussed above, the monthly report from the U.S. Bureau of Labor Statistics informed us that the U.S. added 339,000 jobs in the month of May, and the prior 2 months, April and March, those were each revised up by nearly 100,000 each. This is one way I answer a critic that says, how can you verify these government numbers? Well, if the government were trying to fake these numbers, they would wait. Why would they wait 2 months to improve numbers like they just did in that report? Listen, you can be conservative, have a biblical worldview, meaning be pro-life 100%, pro-biblical marriage 100%, pro-6-day creation 100%, and not be a government conspiracy theorist. They're not always trying to lie to us. They do lie, but not with economic data. Anyway, rant over. This means in 2023, we've added 1.5 million jobs, more evidence of the lack of recession on the horizon. The job gains were broad-based, 64,000 in professional and business services, 52,000 in healthcare and government employment increased by 25,000, transportation and warehousing, that increased by 24,000. The unemployment rate did tick up to 3.7%, but as you can see on your screen, that number has just been range bound this entire year, bouncing in the roughly 3.5% range. Finally, average hour earnings are continuing to decline, meaning that job switchers that have pushed the cost of labor up over the last few years, they're losing their upper hand, which will be something that the Fed wants to see to slow down their interest rate barrage they put on the U.S. economy, because wage gains that are more modest help keep inflation down. Point number 3, the Federal Reserve released its Beige Book. They release that 8 times a year, and they do it about 2 weeks before each FOMC meeting. And Chair Powell, if you listen to his remarks at those FOMC meetings, we can conclude that he pays attention to this Beige Book report when making policy decisions. So let me summarize it for you to save you from reading the 32-page document that gathers anecdotal data and information on the current economic conditions in each Federal Reserve district. Now, first, economic activity, according to the Beige Book, was little changed in April and early May. To get into the specifics, half of the Fed's 12 districts said there was no change in economic activity, 4 noted small increases, and 2 reported slightly modest declines. The employment situation increased in most districts, though it's slowing more than previous editions. And the contacts that help get the report data together, they discussed that hiring was a bit easier in construction, transportation, and finance. Regarding prices or inflation, most contacts reported moderate price increases with small decreases in prices around shipping and certain raw materials. And home prices and rents did rise in the report relative to the last report, where they actually didn't rise, they stabilized. So what's the bottom line with all that? The report does give the Federal Reserve the ammo they need to point that there is a slight slowdown amongst hiring, between their contacts, demand amongst consumers, with most districts reporting that flat economic activity we talked about in that first point. There's one final straw that will give the Fed ammo to raise or lower the Fed interest rates, and that's going to be the CPI report on June 13th, which is actually the first day of their Fed's FOMC meeting. I was happy to see that one of the regional presidents, President Jefferson, said that maybe they should pause and continue to gather more data instead of punishing the economy with another rate hike. And finally, point number 4. For the first time since 2018, banks are going the wrong way in terms of the amount of money on deposit in their banks. And it's the largest amount of money leaving banks on record ever. To be fair, the FDIC data that pulls this together only goes back to 1984, so technically it's since 1984. But banks are dealing with twin problems, and I might even say they're dealing with triple problems. The first of which is the failure of SVB and First Republic, and then you've got Western Alliance and PacWest. They're teetering, and so consumers are worried about their money being in the bank. Secondly, money market funds, treasury yields, they're now both safely in the 5% range. And thirdly, and this is my opinion only, consumers are sick of getting ripped off by their banks, whether it be the fees, poor service, or just their general lack of trust overall. These online banks, they actually still have been able to grow their deposits. Banks like Ally, Goldman Sachs, Marcus, and Capital One, they actually saw their deposits climb recently. But the difference why they're growing and big banks are declining is the yield. Large banks' yields is averaging 1%, while online banks have an average yield of 3.2%. Still not as good as those treasury bonds and money market funds, again around 5%, but at least respectable in our current rate environment. To be fair, banks do have the cost of running large regional banks have the cost of running a branch, which can be roughly around $500,000 a year for a mid-sized branch and $1.3 million a year for a large branch in a large city. But they're just not paying anything, and that is contributing to all this money flowing out of the bank and going to these other more appropriate and respectable sources. Maybe it's time you evaluate your emergency fund and savings account. So talk to your financial advisor, financial planner today. So thanks so much for watching the What We Learned in the Markets This Week video. In the comment section, you can actually go down there and schedule a meeting with any of our financial coaches. Our financial coaches are folks that will help you in baby steps 1, 2, and 3, get out of debt, stay out of debt, live on a budget, hold you accountable. Or you can also schedule a meeting with any of our financial planners who will help you in baby steps 4, 5, and 6, get on a plan to start executing baby step 4 for retirement, get on a plan to save for your kids' college if that's applicable, and get on a plan to figure out how to pay off your house before retirement, or in the next 7 to 8 years is what the average person going through Dave Ramsey's Financial Peace University and Baby Steps program pays off their mortgage, 7 to 8 years on average. Also, would you do us a favor? Would you hit the like button and the subscribe button. What we're trying to do there is trick Google and YouTube's algorithms into thinking this content is actually helpful and enjoyable to people. Hopefully it is. Being a little facetious there, but to get our content out to more people, those two things have to happen. So we appreciate those that do that. Thanks so much for watching this week's video. We'll look forward to seeing you next week.